You have arrived to the Plunge into Prosperity podcast, where sacred wisdom meets regenerative wealth. I'm your host, Brandi Kolosky of Sacral Capital. Now let's plunge in. Welcome back to Plunge into Prosperity, episode 25. I am your host, Brandi Kolosky, founder and GP of Sacral Capital, Sacral Fund I, and Sacral Sisters. I am so grateful you are here with me today. Today's conversation is one I've been looking forward to, as it will be full of technical wisdom in the venture and private equity space. My guest is Seth Levine, a co-founder and partner at Foundry, the venture capital firm in Boulder, Colorado, that he opened up in 2006, which today manages nearly $4 billion across its funds. Seth is also a partner at Quantum Advantage Capital, co-founder and chief strategy officer of GoodBread, a small business lending platform reimagining how capital reaches Main Street, and co-founder of Pledge 1%, a global movement that has driven nearly $3 billion in corporate philanthropy. He's a trustee of Macalester College and the co-author of 2 books, The New Builders, and his most recent, the national bestseller, Capital Evolution, The New American Economy, which I'm excited to read. I need to go get that, Seth. And he has spent 2 decades thinking about capital from more angles than almost anyone I could bring into this room: equity, credit, philanthropy, and now the philosophy of capitalism itself. I wanted him here because this is going to be a different kind of conversation than usual. Yes, we're going to talk about his story, but really we're going to actually build something together in real time. So Seth, welcome to Plunge into Prosperity.
Thanks for having me, Brandi. I'm exhausted hearing you make that introduction. That's a lot of things, but a lot of other people involved as well, right? It's worth pointing that out. Even my books I have a co-author, so lots of people coming together to do all those sorts of things. But
I wouldn't be here without Arundhati as my right arm either, which you connect with often so far. Yeah, I wouldn't. My resume looks like I've lived 9 lives. Although I've just stayed going with what my gut feels and my sacral. That's why it's called Sacral Capital. And I just keep moving and just grabbing what excites me. And I fell into the venture capital private equity space. I didn't climb the ladder the traditional way like most people. And so for Seth, those that are new here, tell them why they should continue listening to this episode with you particularly.
First, I just want to give you a little bit of props, because not only did you not get into venture capital private equity in sort of the traditional way, but I think because of that, you've got a really interesting philosophy around how to operate as an investor, right? Which I think is really, really interesting. And it's one of the, like, you're in some respects like the poster child for why actually getting new people to be capital allocators and embracing them into this community is so helpful, as opposed to being going to an investment bank and then being an associate at some large, Sand Hill Road venture firm, and you kind of learn how to do it that way. And then you become a partner. Like, yeah, that's fine. That works for some people, but like actually, and you're this great example of this, like bringing new people with new ideas, new perspectives, new way of looking at things into this work is great. And it's one of the reasons why you didn't mention this, but like Foundry is not going to raise any more funds. We're gonna close our doors. And one of the reasons that we had set the firm up not to be generational back 20 years ago when we started in 2006 is because we felt like if there needs to be more room in the world, we sort of had our time on stage, if you will, and now we're stepping aside. For me, that looks like this new fund, Quantum Advantage, that you mentioned. But for some of my partners, that means nothing else, right? They're going to kind of step back and do the other things that they're going to do, but nothing formal. But it was like a recognition that actually, and it's not that every firm should be operating this way, but at least for us, philosophically, we wanted to give some space for other people to sort of come into that room, right? And I think that's important, and you're an embodiment of that.
Thank you. Yeah, I've noticed that a lot of new funds are popping up that are fresh-minded. And then I have been reading the studies that, I believe, correct me if I'm wrong, if you know the stat better than I do, 40% of all the money raised and allocated out is from one of the top 5 firms that are out there. So they've kind of grabbed the stat
that I've heard is even more concentrated, right? I mean, it's like
is it 60%? I feel like it might be 60.
What I heard was over 60, right? So I think it is massively concentrated. By the way, that concentration exists in companies as well.
Yes.
And so a very small number of companies garner a huge portion of investment dollars. And by the way, we're seeing that in exits at the moment, right? We're speaking, whatever, a week, let's say, not even quite, after SpaceX goes public, $75 billion IPO. I mean, great for them. And obviously there's a lot of shareholders of SpaceX, not taking anything away from them, but highly concentrated, right? And right behind that, we've got OpenAI and Anthropic. I don't know how big those IPOs are going to be, but let's say they're each 25 billion. They probably are going to be more than that. And so now we're talking about, call it let's say a little more than 25 billion, $150 billion into 3 companies from the IPO market. Like, now that's incredibly concentrated as well. By the way, that is like 4 years worth of IPO tech allocations, right? So it kind of leaves everyone else fighting for the scraps. Not awesome.
No, not awesome, but I'm excited that you and I are starting this off like an all-in podcast, because I'm obsessed and it just is feeling like that we're going to get to have those type of conversations, because I believe I did hear that stat from them specifically, but I'm constantly reading research papers in general. And with that being said, I know that Jason and the guys and also our government, they're looking at ways that new capital can be coming in from working with the KYC on the accredited investors. So I'm excited for that to start unfolding, because I created an SPV specifically for women to come in, so they can come into my cap table, so that 35 unaccredited can go into the SPV. And I've been raising money from women that are coming into being accredited, but just not there yet. But they're intelligent enough. They make investments already, whether it's in stocks, and then they're investing in homes, or so they're not, uneducated on investing. They're just not hitting those numbers that the government wants them to, right?
Well, I mean, if you listen to this, so I mean, just follow up on your all-in comment.
Yeah.
If you listen to this last week's podcast, Jake now had a rant again,
Friday,
and it's not his first, right?
Every Friday.
And none of it makes sense.
It's religious for me. So go ahead.
Right, you and me both, right? And by the way, there's a governmental philosophy that pervades so many things that the government does, which is incredibly pejorative, right? Which is like, the government is here to prevent and like to watch over you, right? And to prevent you from doing things with your own agency that somehow they know better for you. And I think that that's both a very cynical view of humanity, and I also just don't think that's a good role for government. And it's not, I mean, look, I believe in social programs. I'm not a Silicon Valley libertarian. That is not my world and philosophy. Yeah. It's fine that it is some people's, but it is an incredibly pejorative view if you're basically saying to people, well, you may be really sophisticated, or you may, let's say, own and run a small business, but if you're not worth at least this much, then you really can't have access to this asset class. And part of what's happening now is that, like, companies are waiting later and later and later to go public. And so the people that are sort of accumulating that wealth creation, if you will, are, again, back to our prior conversation, more and more concentrated, right? We don't have the ability for people to buy in the public markets. And you think about sort of the initial wave in the internet, Amazon, even Microsoft, Google, et cetera, like where they went public relative to where they are now, there was lots of opportunity for any retail investor to buy those stocks and participate in that upside. I'm not saying there won't be upside for whatever, SpaceX or OpenAI or Anthropic, and I'm not giving stock advice, but I'm just like, there will be some upside there. But when you go public and you're already worth $2 trillion, a lot of that value has already been captured. So it's just, I hate that. And by the way, you didn't mention it, but it's like the next version of that, which is like, even if you are accredited and you're raising funds, there are still limitations on how many investors you can take. Things it's just so arbitrary. There's no reason for it.
Yes, understood. I know that a different podcast maybe I was listening to, one of the gentlemen goes, well, even I know very, very wealthy humans, and they make very bad decisions sometimes investing. So
there's definitely not a direct line correlation between wealth and smarts, right? Or investment savvy, let's say.
No, not at all. Not at all. And part of my SPV raise for the fund, we also provide like webinars on educating in all parts of financial literacy, from how to structure your tax and to trust attorneys coming on. And, so there's all these different ways that we can go around it.
Well, and part of what you're describing, so two more things on this subject, just because I think it's really important to put a pin in this. Like, one is, you're going after a very specific group of people, women in your case, who have been historically underrepresented in investment and sort of access to some of this stuff, right? So by putting these guardrails, I'm not saying women aren't as wealthy as men, but But by putting guardrails arbitrarily, right, you end up preventing this sort of upward mobility of groups that maybe haven't had as much access to that sort of upward mobility. So I think that's really important. And then also the other thing is like, you learn by doing, right? And so
Yeah.
it is important that, and I mean, your description of like webinars and how you're educating your community, but also you're educating your community by just simply giving them access to the asset class so that
Yes.
they experience it themselves. I don't know what
You
the right I was going to use a golf analogy.
You just gave me goosebumps, because that is because a lot of humans, not even just women, don't even know you can get into private markets in BC. They think it's just like a particular club. Some guy friends of mine from high school just started hitting me up wanting to invest, and I was like, and they run a couple $1 million business, that they grew from the ground up, and so now I'm going to be creating an SPV for them to come in, and so. And they're like, I've always been really, intrigued by private equity and venture capital. And I'm like, yeah, it's here. Here you go. Yeah. They had no idea.
What can you teach them, right? Like, great, embrace that.
Yeah. So I'm excited, but I'm also, there's a fire in my belly. So it's both like fun excitement and then just like grit excitement. So
one of the just one of the things I think is important as people are listening to this is like, well, what can you do?
Yes.
It seems very self-serving when someone like me, like whatever, calls up my member of Congress and is like, hey, this is effed up and it should change, because it sounds like I'm just like looking for more investment dollars. It's totally different when someone who is an investor calls up and says, hey, it's not fair that I don't have access to these sorts of investment vehicles, and I have opportunities to invest, and yet I can't because I don't hit this arbitrary threshold that the government has decided I need to hit. And so I like, that is like, I mean, members of Congress actually listen to this stuff. And we already saw a version of this, right? The Jobs Act way back, whatever it was, a decade ago, it didn't do a great job of it, but at least it loosened up some of these requirements. So like, there's absolutely something you can do if you're listening to this and you're like, yeah, I want to get in on that. That seems totally reasonable.
You've lit another to-do list for me. I love it.
We got to activate our networks on this.
I'm going to do that now. I'm going to do it. Yep. Beautiful. So how did you first discover, Seth, your own personal definition of what true prosperity really means to you, and how are you actively embodying it and stewarding that vision separately from your life, your personal life, and then in your work?
Yeah. I mean, I think I just grew up with this idea of like rising tides lift all boats, and this notion that if to be like effectively a part of community, you need to be giving as much as you're getting. And then I met Brad Feld, who's my partner now. I worked for Brad for a little while. And it's funny, I recently sent him a note about this because I learned so much from Brad. He's like, truly, outside of like my family, like my wife and kids and my mom and dad, my sister, like Brad's like the most important person in my life, right? Because I learned so much from him. He gave me such an incredible opportunity first to learn about venture capital working for him, but way back in the day when I was working at SoftBank venture capital back in the early 2000s.
Wow.
And then ultimately to partner with him. And by the way, I can't express to you, Brandi, how generous he was to me and to the other founders of Foundry when we all came together and created this platform. It was a completely equal partnership from the beginning. And that was just this incredible gift to me, both a literal gift, like financial gift, because we could have been very unequal and that would have meant a lot to me financially, but more importantly, because we would have gotten to equal, I'm sure. But more importantly, just sort of philosophically. And one of the things I said to him when I wrote him this note, this was a couple months ago, was specifically around this idea of give first, right? Which is how we describe this give before you get philosophy. Brad actually just wrote a book about that called Give First.
I gotta buy another book then again.
You gotta buy another book. Yeah.
Exactly. I love reading. I'm a bibliophile, so good. The more the merrier. I read like one book to 3 books every 3 to 6 months. So I try to do at least 2 a month if I can. Whoa, yeah.
But my kids are grown up now, so it's a little bit easier. Back in the day, it was harder. So.
I don't have any. Go
ahead. You're
on
on the front end of that. Yeah, you don't have to get that, right? But yeah, no, I encourage that. Like, read as much as you can. Like, why not? By the way, I read. My wife also owns a bookstore, so there's.
Really? Oh my gosh, I must visit it. I go to Colorado once or twice a year. So
It is truly the most spectacular space. I mean, she just did such a good. She's a real estate like a developer, and so she did. So she owns the space the bookstore's in.
I would love to interview her.
She's fantastic. And
what's her name?
Amazing. So anyway, we always have books around because
what is her
when
name?
you like, well, it's a bookstore. There are a lot of books around.
What is her name?
Greeley Sachs.
Greeley. Okay.
And as long as we're pitching the bookstore, it's Composition Shop.
There you go. Composition Shop.
They've got an Instagram, Instagram, and you can follow them.
Love that.
Things.
Yes.
So
back to Brad being a prosperous human in your life.
Well, and this give first idea. And so what I said to Brad was, I posed a question to him, and I basically said, I think I had this notion inside of me, but I wonder if it would have come out in the way that it did without you, right? And without sort of your, not just guidance, but his leadership around this idea of give first and of sort of community involvement. And I think the answer is no. Like, I think that amongst the million things that I've gotten out of, being a business partner and best friends with Brad is this, like, imparting of these just critical foundational concepts for me around what it means to be part of a community and giving first before you're getting things like that. And so anyway, that's a longer story of sort of saying, like, give first really, for me, codifies the things that I care about the most. And I feel like, my job has always been both in terms of like direct investing. Now we invest in other funds. Also just the other sort of like, whatever community-minded things that we've done, businesses I've started, things like that, has always been like, how do I become the catalyst for empowerment of others, right? And I think about that a lot because I think that that's what drives satisfaction for me, but it also is sort of how I want to be known and
legacy, your legacy.
And my legacy is like not, it's less about what I did and it's more about what I enabled others to do.
The ripple effect, for sure. Yeah. Oh, that's beautiful. Thank you for sharing that. And so let's start at the foundation. You co-founded Foundry in 2006 with an explicit, with Brad, roughly a third of your capital deployed in Colorado, a third in the Bay Area, a third everywhere else. You kind of zoned in on that area, a direct rejection of the assumption that great companies could not only come out of Silicon Valley. So 20 years later, Foundry now manages nearly $4 billion across multiple funds. You built it on an intentional non-legacy structure, like you shared earlier. No army of junior associates groomed in the firm, a fund designed to eventually close its chapter rather than perpetuate itself forever. I think about capital concentration, as well in different dimensions, not just geography, but demographics and so forth. And as you know, tell us a little bit more about your rule of thirds 2 decades ago and what did you understand about capital concentration then to where it is now?
Yeah, so I think one of the founding insights of Foundry was that great companies could be built anywhere. And that was not to say that they should not be built in Silicon Valley. And some of our biggest wins were companies that were Silicon Valley based. Fitbit comes to mind, for example, right? Which is a big early win for us. But there were plenty of others that were in Austin or Seattle or Denver. And philosophically, we believed when we started Foundry that a great company could be built anywhere, and therefore a great venture firm could be built anywhere. And that really wasn't the case, right? There was, at the time we started this in 2006, there was Silicon Valley and maybe Boston, right? New York wasn't even really considered an actual venture market. Certainly not.
Yeah, no, they were a high investment bank only and preparing for IPOs, really.
100%, absolutely. I mean, so much so that actually many of my first investments were in New York because as a newly minted partner, I was like, where can I go where I can make a name for myself. And at the time, New York didn't really have many firms running around, right? I mean, First Mark was still Pequot back then. Union Square existed, but they hadn't even invested in Twitter at that point.
Miami too. Miami now has a lot popping up.
Absolutely. Yeah, there's a ton in Miami, ton in Austin, right?
Citadel just moved their HQ to Miami a couple years ago.
Well, a lot of people are moving to Florida. Whatever.
I left.
Yeah, right. Well, I mean, you're in Puerto Rico, right? So you also
a lot of people are now. I'm like the future Miami version here.
And I think we'll look back whatever, 20 years from now. And there will be a bunch of additional markets, Puerto Rico being one of them, where like people moved and they want to invest where they are, and people want to start businesses. I mean, it's more and more and more mobile, right? We certainly like that was always the case. And then obviously 2020, everything blew up and people moved out of wherever they were because they wanted to live somewhere more, whatever, rural or isolated or whatever it was.
Yeah.
And so all of a sudden companies started popping up kind of wherever. And then the companies were virtual. So it's sort of like, well, where we used to track like where each of our companies was. It became much harder to do that because it's like, well, is that where the CEO is? Is that where they fly into to meet because they need a third party location? Is that whatever, right? I mean, you just never. And so, like the view of that changed. But philosophically, it was really important for us to say, hey, great businesses could be built anywhere. Therefore, a great venture firm could be built anywhere. We became the largest venture firm between the coasts, having raised, sort of all these funds. We don't number the funds. I think it was like 9 or 10 funds, depending on how you count, some sidecars, and for nearly $4 billion. Like all of that happened in this like kind of random-ish spot in Boulder, Colorado. And like that was amazing, right? And what we've tried to do, because we now also invest in other venture funds, mostly emerging managers, so smaller funds. Some of those are in California, but a lot of them are elsewhere, right? Toronto, Boston, New York, Austin, like anywhere you can imagine, Minneapolis, et cetera. And so we tried to perpetuate at least our own views on where funds could be domiciled by investing money in all of those locations, right? And I think that, again, I think that's good for the world. And I think sort of back to one of your original comments, which is capital has become really concentrated. One of the reasons that's bad is because capital concentrates in sort of these historic areas, right? So if you look at the funds that underpin that, whether it's 40% or 60% highly concentrated capital, they tend to all be Bay Area based, right? Because that's where those funds were. And so that kind of perpetuates this sort of insularity of business. And again, it's not a knock on the Bay Area. We still invest there very actively. Last deal I did was Bay Area based as well. Like there's plenty of good things going on there. And there can also be great things going on elsewhere, but we self-perpetuate this idea that the Bay Area is the only place. If we concentrate all the capital there, sort of by definition, that means companies need to go there if they're going to access that capital, which means that there's more likely to be more successful companies there, which means funds are more likely to say, hey, we should domicile here. And then it's just this like, either virtuous or vicious circle in terms of how things work. So, and I want us to get away from that because I think it's important that we, as I said from the outset, have different people allocating capital. They allocated from different places. Like all of this is good for American dynamism. And American dynamism is not doing so great.
Yeah,
right?
All my initial first 17 women are in St. Augustine and Jacksonville. No one would have ever known. Everyone's like, how did that happen? And I'm from North Florida. So my family's living in Gainesville, St. Augustine area. And then just some girlfriends of mine, I sponsored an event in Miami for either one of the crypto weeks or finance weeks. Yeah, finance weeks at one of the hotels. And then another woman was there. She had just moved from New York City to St. Augustine. And she's the one that her name is Ala, give her a shout out. She helps women build AI into their businesses. That started the waterfall effect. Yep.
And that, by the way, that's how it works, right? It's like and it's really interesting especially when you get into some of these markets that are a bit overlooked and you're asking people questions that they've never been asked before. Hey, how do you think about private investing or venture investing or PE investing, right? And they've never had to think about that. And all of a sudden they're like, this is pretty interesting. And then they talk to a couple of people. And then you've got, to your point, a whole bunch of investors in North Florida saying, hey, I really like this. I want to participate in that.
Yeah. The women, I would say half of the women did their due diligence deeply on like the companies that I have term sheets signed with already. Because I also am launching my fund, not the traditional way where you go raise capital based on the industry, because I was given a lot of pushback. And I hate to, I'm not a feminist by any means, but I hate to like always be bringing this up. But I was given a lot of questions that I normally wouldn't be asked by men when I was trying to raise the bigger checks first. So I said, you know what, let me pause. So I went and did full due diligence on 5 companies and signed term sheets with them so we could actually show what the real numbers would be looking like once we did allocate to them. We're going to have 20 in this fund, 20 portcos. And so half of the women really did cross-reference. I gave them access to the data rooms as well. I'm a big stickler. I I have a request list. I do customized request lists for each company, and they have 90 days. They don't know it, but I have a timer on the back end. Well, now everyone knows it, but they have a timer. If they can't put together the data room I want within 90 days, then there's no investing, because if they can't be organized with their documents, they're not going to be organized with my money or my LP's money, right? So the women, they some of them really dove deep in and took a few weeks, which I really commend them.
What you just said, though, right, about getting asked a different set of questions is absolutely true, right? They've done studies on this, and they've normalized for the script and things like that. And depending on who delivers it, you get asked different questions. And by the way, I've heard that from lots of different female GPs, right?
Okay.
Or female CEOs, founders raising money, who are like, yeah, I get asked a very different set of questions. And some of them, by the way, have like a male co-founder, and they're like, yeah, when he's in the room, we get asked different questions than when it's just me pitching on my own. And that's like how society works. So
and I'm not downing it. I know that it has been just the brain doesn't like change, no matter if you're a male or a female, right? When we go into these type of new ways of evolving, it just takes repetitiveness and getting used to. I have this little weird quirk of mine where I think that, men experience their wives and mothers at home. And so they're just subconsciously programmed of how they're going to experience a woman because when you're investing in someone, you're marrying them. So that's it, right? Yeah. So they just have this subconscious thing of how that experience might play out based off of sometimes what they experience at home.
Yeah, I mean, well, what you're saying is like we're all products of all these inputs from our lives, right? And you can't just leave that alone when you get into a room, right? And so I think that like that's why and how we behave the way that we do, both good and bad, right? I mean, we evolved. That has been very effective over an evolutionary time frame, and it's been very ineffective in many situations in sort of our current time.
Yeah, understood. So I'm going to dive into your expertise and bring you inside the room on my side for a little another question. Because you spent 2 decades building structures most people in venture never even think about to question, and I want your honest, unfiltered read on mine. So I'm building Sacral Fund I as a hybrid venture capital private equity vehicle. I studied way before, and I think when you and I first spoke, I shared with you. I before everyone started talking about it's trending in the news that venture is kind of failing, I already saw it because I was an MD at a VC prior, and we were also the first to do digital securities issuance. Turn the traditional shares into digital with Vertalo and Tezos T3. So I also saw the new evolution of that, but we were a little too early. But we did raise on it. I raised several million just for that specific structure. And so with Sacral, we're doing this hybrid VCPE because I wanted to offset the risk as well as bring in more control and then create systems where we're repairing systems. Whereas the venture play will help the PE play, or the PE play will help the VC play, whether in different parts of their growth cycle and stages, right? So when we underwrite across these 4 pillars, aviation, space tech, consumer health, which includes organic agriculture down to your at-home kits or your wearables, like digital infrastructure. So your build power and your like data centers or superconductors, etc. And so some of these are asset heavy, cash flowing, downside protection. Some behave like growth optionality, technology risk, founder conviction. And by the way, all the founders that I'm choosing, they are serial exiters. There must be a woman, not co-founding, but at least a woman leading with them, because that also reduces our deal flow optionality. And a lot of these people I've known or worked with in some capacity in the past as well, so I know that they have high integrity in their work, right? And so I just want to get your insight on that.
Yeah, so I think that to the extent to which you can control your capital stack, like that sounds great, right? I think the thing to understand and acknowledge is LPs, traditional institutional LPs, struggle with any model that feels like a new model. And I just experienced this myself when we were fundraising for this next platform that I've been working on. One of the ideas that we had was to raise it as an open-ended fund, a little bit of a different fund structure. So that would be sort of a hedge fund style structure, but applied to to venture capital style investing, and it's like people like steam coming out of people's heads. They understood why that made sense and why that was more aligned, but then they didn't know what bucket to put it in. And so ultimately, in our case, we reverted back to more of a traditional venture structure. I was kind of bummed about that. I wanted to try something different just because it seemed like it was interesting and more aligned.
Yeah.
And so just you got to keep that in mind, right? And the insight is that I used to think that LPs had the same job as GPs. And now I realize after being in venture for 20-something years that that's not the case, right? They have very different jobs. They're capital allocators. And there's just like different both incentives, financial and otherwise, and a different philosophical approach to investing. And so the thing I would say to you is like, be careful as you think about sort of bridging ultimately, and if you think about bridging ultimately into institutional capital, that institutional capital struggles to want to put people into a bucket. And so if you're doing both PE and venture, they're going to be like, well, pick one. We don't know where to put you. We literally don't even know in many cases, which person you should talk to within our shop. So that's the downside. The upside is that you've done your research and you think it's a better model, right? And so to the extent to which you have...
Well, we stress tested it. Well, we've even stress tested it in using the real term sheet signed and then breaking it down into actual financial stress testing. It's not just based off of just research. It did end up coming out that and that's one of the reasons one of my first investors invested, because he helped actually build the model with us. And he was like, what? It just kept getting better and better every time.
Well, and so once you prove it out, then it becomes easier to go to institutional capital and be like, look, I know it doesn't fit into any of your sort of perfect bubbles, but, DPI is 2x and TVPI is 6x. We're doing pretty well with this model. This is what we're going to continue to do. And that ultimately returns trump everything. And so, it's just, you got to get to that point where you've got returns from a big enough pool of capital that you can raise, even though you've got a non-traditional model. But I very much...
That's an interesting idea. Maybe because I already have 24 million of the 110 million. Maybe I just deploy that and then showcase on a couple plays.
So maybe the thing I'd say to you is fund size is fund strategy. Right?
Yes, it is. That's why I'm staying low on this one.
And I think a lot of GPs make this mistake where they're like, okay, I'm trying to raise 100, but I'll close on 10. Okay, well, that's totally different. The fund strategy for a $10 million fund is totally different than a fund strategy for 100 million. So part of what you have to decide is, at what level can I still execute this strategy?
Yeah, I can't execute it if it's not one.
And so, that's where people's heuristically, rule of thumb, usually that's 50 to 75% of whatever your target was, is enough capital that you can get going on that strategy. But for nuanced strategies, that might be a little bit different. But that would be the whatever pushback or advice I'd give you is look, finish your fund when you get to the point where you're like, I can execute this strategy with this money raised.
Okay, got it. Understood. Okay. All right, perfect. Thank you for that.
Look, you're not bumping up against this, but the truth is the best returning fund sizes tend to be slightly smaller, right?
Yes.
There's obviously there's a little bit at the very small size where you're Chris Sacca and you had a $10 million fund, but you invested in, Twitter and Instagram and a couple things that just went crazy. So those are outliers. But when you get into sort of the normalized distribution curve for venture, there's a bunch of statistics that statistically say sort of 75 to 150, depending on how many partners you have, things like that. That's the best size for a venture fund.
I love and hate that I'm going to call out All In again. I think that they did one of their episodes on this. I think it was David Sachs that even showed. No, it was.
It wouldn't have been David because.
No, it's Chamath. It was Chamath. It's Chamath. He was showing that the new statistics of smaller funds coming out. Maybe it was somebody else. Maybe it was a different podcast. But basically,
it's reminding me of something, and it sounds like something Chamath would have said because he's pretty data driven, right? And by the way, he went from...
Well, I remember what it is. I remember it was at their recent investment summit in California, and one of the guys did a presentation on stage. You know how they had their panels and they filmed?
Yeah.
It was that one.
I listened to that one, right.
And he showed that the smaller funds, your DPI, or not DPI, your returns back to your LPs is lower. But once you start hitting I want to raise a $5 billion fund, then you have to like raise like then you have to return back 15 billion. The bigger the number, the bigger the return has to go back, which is understandable. But I never looked at it from that perspective. And so he said the 50 million to the 100 million is like the sweet spot. So I think he said, so yeah, I'm going to stay at the 110.
Bill Naris, who was one of the founders of Google Ventures.
Yes. Yes.
That was,
you got it.
That was a good,
that was really
I don't know
good.
Bill well, but I've known him for a while. We did some stuff with GV back in the day, and his GV co-founder, Rich Miner, is a very good friend of mine. And they were incredibly thoughtful. It's Google, so they were super sort of mathematical and algorithmic about how they approach things. But yeah, that was a really good one. It's quite short. I think it was like 30 minutes.
Yeah.
So that's definitely worth listening to. And Bill's a super smart guy.
I feel like he would understand my VCP hybrid, right?
Yeah.
Yeah, like
he's always kind of done his own thing, right? So
yes, exactly. And we have similar stories. I had to live in a truck for a few weeks, and he had to live on his floor,
Yeah, right. Yeah, exactly.
And I would have definitely tarred my own roof if I needed to also.
That's right. Yeah, he had the tarring of the roof story.
I
love that. Yeah, he quit his job as an investment banker because he was like, this internet thing is going to be big. And he was definitely right about that.
Yeah. So it would be great to one day be connected with him and see what he thinks about this strategy. So as far as your new book, Capital Evolution, goes, though, because we're talking about the evolution of capital right now, it makes the case that we're at an inflection point, that the neoliberal version of capitalism most of us grew up inside of is failing. What's replacing it isn't left and right argument. It's what you and Elizabeth McBride call dynamic capitalism. I think it's a profit balanced with purpose, climate, and equity treated as core strategy rather than externality.
Yeah. And I wouldn't even necessarily say balanced, right? I think one of the challenges that we have as we describe it is people are like, that sounds like this like lefty version of capitalism that's sort of like quasi-socialism. And ironically, part of why we wrote the book was to be a defense of capitalism, because socialism does not work, right? That's been proven time and time again. People need to have a stake in the markets. We can't have a bloated government, which we do right now. In fact, there's a whole chapter on like government not being the solution. And so we argue but at the same time, the current version of capitalism that we've been operating under has created an economy that is less dynamic. Dynamism in the US has gone way down, as measured by all sorts of different types of things, but wealth mobility, ability to start businesses, ability to sort of manage a $1,000 emergency charge, things like that.
Yeah.
All of that stuff has been declining at the same time that wealth inequality has been going up. And our argument is just a very practical one. Like, we need to find a way to have more capitalists. And by the way, when you hear these AI founders talk about, sort of how can they contribute back to, I don't know, society fund of some kind, sovereign wealth fund is what people like to call it. Not in the Bernie go seize a bunch of private property type of version of that, which I think is terrible and will never work. But in a more sort of holistic, hey, we understand that we need to be a part of the solution, not just part of the problem, or even for that matter, what Brad Gerstner has been pursuing around these Trump baby bonds, essentially, right? Giving everyone who's born in the U.S. some capital that they can later use for education, for starting a business, et cetera. We argued for that in our first books 5 years ago, right? And by the way, it came up again in Capital Evolution. So awesome. I'm glad that I'm sure he hasn't read it, but I'm glad that Brad and Trump are taking some of our ideas. So, but I place those in context because I think sometimes when you start talking about like balance, profit and purpose, what we really mean is take a longer term view, understand like the Business Roundtable does, right? BRT is CEOs of the sort of 200 or so biggest companies in the United States. They also in 2019 recognized, hey, it's not just profit, right? We've got employees, we've got community, the environment. Like, we need to be good stewards of all of these things in order to set ourselves up for long-term success. Those things are all absolutely true. And the balance of those things is nuanced, and it's each company needs to kind of figure out what that balance is. And we tell these stories, like the absolute rapacious version of neoliberalism, Friedman economics, Washington consensus, however you want to describe it, actually doesn't work very well, right? And it's examples like GE, who kind of, chased stock price for years and years under Jack Welch, and it turned out to be all be a house of cards, and is now I mean, worth fraction. I mean, it got broken up, so it's hard to say exactly, but it's worth a fraction of what it was worth before. That wasn't real. What's real are companies trying to build for sort of longer term success. And I think that CEOs have a really challenging job. And we talk about this very much in the books. The book's designed for people like you and me to read, for academics to read, for people that own and operate businesses, or people that work for businesses, but also for CEOs who have to make some of these decisions, and like balancing how you think about sort of how you manage your employees, where the line is between putting your thumb on the scale. Google is a great example of this, right? I think they really struggled a few years ago around, especially as AI was just coming out, about like how do they manage AI in a way that they thought worked for them. And it turned out that they put their thumb on the scale too much, right? And they were getting, that's where you get Black George Washington, right? Like, it's okay that George Washington was a white guy. That's just what he was. And so we don't need our AI to pretend like it was something else. And so they went a little bit too far, and then, then they were able to correct. And I give them a lot of credit for sort of finding that balance, for leaning into AI in a productive way. Obviously, they've grown their business incredibly. So just as an example. And so I think that those stories are important to tell, but I want to be clear. The book really sort of argues for this much more kind of middle ground.
Understood. So because I speak a lot about conscious stewardship and regenerative capital, right? That's really, when I speak with women, they really tap into that specifically, but then a lot of my investors do as well. Is the idea that capital moves matter, how capital moves matters as much as how much it moves in general, right? So I'd love your honest perspective when you sat across from people like Jamie Dimon or Larry Fink for this book. What convinced you they are genuinely serious about that shift? And where do you think it's still mostly rhetoric, and bringing it back to where I live? Do women-led businesses and emerging fund managers actually benefit from that shift, or does stakeholder capitalism still mostly reshuffle capital among the same incumbents? Which that brings us back to the very beginning of our conversation.
Absolutely. And so let me bring it all the way back to the beginning, which is that there's massive concentration. 80% of money held in sort of large financial institutions is held by 4 money managers, right? And so it's incredibly concentrated. And while a number of those money managers make statements around sort of what it is they value and how they think about investing, the truth is it's pretty opaque. And we argue there's a chapter on finance that talks specifically about this, but kind of dangerous to have mostly the men, because these firms are mostly run by men, but have these men sort of be the stewards of what, they use language like, invest for purpose as well as profit, things like that. But like they end up being the only arbiters of what that means. And when you're State Street Bank or Larry Fink at BlackRock, like you massively move markets, right? And so, so what we describe is being careful about that. Now, I think your point is well taken, right? We would do much better to have more different types of people running money. And frankly, we as a society, we would do better to not have that as concentrated. I don't know how you fix that, because I'm not one to say, the government steps in, for example, and says, oh, you can't manage more than X dollars. And that doesn't make sense.
I think just continuing what I'm doing in my lane is doing enough, is doing what it needs to be doing. And then doing that call on to the government for building more awareness on the accreditation. I think that these two things are good for my lane. Yeah.
Well, I think that's right. Yeah. Well, I mean, the ultimate solution is you create a massive platform, right? I mean, like that we've seen in our lifetimes, these big companies get built up and all of a sudden be worth, not all of a sudden, but be worth $1 trillion or a couple $1 trillion. Actually,
people think that everyone thinks like, oh, I saw a photo last night of Elon sitting on a floor in a small, like little small warehouse room with all these like different tool parts and everything all over the ground. And that was, it was kind of a while ago.
Well, SpaceX started 25 years ago, right? Like this was an overnight success story.
People think like, and he also, people love to talk shit about him. And I used to call myself in my social handles way back in the day, Miss Elon Musk, until I didn't want to be the 10th wife. But I'm just kidding. But as far as like just the grit and just the focus and that's how hard it is. And I know I don't even want to go into the details, but I have put a lot of energy, and I will continue to do so in this fund. So, yeah.
Yeah, which is, by the way, what it takes. And by the way, there's a lot of power in, I mean, my first book was about power of small business.
Yes.
Called The New Builders. And the truth is 50% of employment and 40% of US GDP comes from small businesses, right? Like,
yes.
It feels, because it is more fractious, right? There are many more of them, so they're not as organized, they don't lobby in the same way as, whatever a Google does, or
yeah.
An Amazon or something like that. But there's a lot of power in that. And I think that sort of banding together, coming together, building platforms that are either by themselves or together with others can move markets, right? And that's what you're literally trying to do. We need more and more and more of that. And the fix to the concentration of power is to create new sources of power.
Yes, you're right. So that moves me into your pledge 1%. You spent 2 decades inside the Give First ethos. And then you took that further by co-founding Pledge 1%, which has now moved nearly $3 billion in corporate philanthropy globally. And I think about Sacral Sisters, the SPV, in that way too, where, it's not just a fund, it's a community designed to recycle capital access back towards the next founder coming up. Because a couple of the women were actually running due diligence on their companies to invest in them as well. So it's like this beautiful circular model there. And watching, what you've learned watching Give First operate at the scale about whether generosity inside a capital system actually compounds over time and whether it stays as a side project next to the real business returns. Give me more insight on your Pledge 1% and how people can get involved if that's an opportunity.
Yeah, the insight in Pledge was sort of a couple of things. One is that we all build companies in the context of the communities that we live in, that our employees live in, et cetera, and that there are externalities to our businesses that don't get priced into taxes or how we pay for where we are, right? And that we have a responsibility as business owners to help give back to those communities in whatever way we think is appropriate. And so that was insight number one. Insight number two is it's super audacious, especially at the founding of your business, to be like, hey, this will be worth something someday, and I'm going to give it away, even though today it's kind of worth nothing, but I know it's going to be worth something later, right?
I've moved that way in life a few times. Yes.
Yeah, absolutely, right? You got to, assume success. So 12 years ago or so now, Scott Farquhar, who's the CEO or founder of Atlassian, Mark Benioff, who from Salesforce, Suzanne DiBianca from Salesforce, Ryan Martin from Rally, a couple of other people, and I came together, it's a pretty small group, and said, there's a better way to do this. And why don't we encourage, it came from sort of the 1-1-1 thing that Benioff does at Salesforce. This thing way back.
Love him, by the way.
Yeah, it's fantastic, right? And Suzanne was running that for him. And so we created this platform to say, hey, we're going to make it as easy as possible for companies to give back. 20,000 companies signed up. We've activated about $3 billion to local charities. Although I will say, Brandi, it's been interesting. Like in the last couple of years, philosophically, I think that this new generation of founder has maybe shifted their thinking on this a little bit. And I think
on philanthropy?
Yeah. And like becoming less philanthropic, right? Less focused on sort of the community aspects of their businesses. And I think that's an interesting trend to watch because, I guess there is a value judgment there, but I think it's something you need to think about.
For me, the energy of money, because money is energy at the end of the day, and it is, it's called a currency for a reason because it's energy, it's a current. And when atoms and molecules move really fast, what does it happen? It creates a solid energy from the sun, grows the tree. Where do we get our physical money? The tree, the paper. Like, it's just like, there's so many things the way you look at money. And I was put in meditation school when I was 15. And so that's where I've been learning a lot of these philosophical ways that I lead my life and not having attachment or fear. But money is energy. And when you're tithing, I always get the word mixed up, but it's one of them, is the energy coming back to you, right? It's like, I don't know, they might see a karmic reaction to that. That's all I have to say.
Yeah. Well, I think that's true. And that's part of, the give first. It's exactly that, right? It's this idea that we give before we get.
Even if you just give physically, even if you're just donating time to
Sure. Yeah. We all have things of value. So that's where the market is shifting. And, we're talking at Pledge about, hey, do we need to, certainly not giving up on our mission by any stretch of the imagination, and it's been wildly successful. But do we need to think about an evolution of our own model? The longtime CEO of Pledge just retired. And so it's time, and that's an opportunity both to celebrate Amy and her accomplishments, but also to be thinking about some new ideas. Scott Farquhar and I have been talking a lot about this because he left Atlassian. He's sort of, I don't want to say semi-retired because he works super hard on all sorts of different projects. So that's not a fair way of describing it. But he's very involved in Pledge, and he and I have been talking about, like, what does this give us an opportunity to do, turning over a new page? And I think that's what's exciting about sort of organizations and this. You use the word regenerative, right, a couple times. You think about sort of some of your investments, but I think we have an opportunity to be regenerative. In the same way, I feel like we've got an opportunity to be regenerative with Foundry, which is we've now seeded, if you will, to keep the plant analogy, all these other venture funds, and they can go on and do amazing things, right? And hopefully we helped a couple of them really get off the ground and put the name on the map. And so as Foundry sort of goes away, right, we sort of rot back into the earth and new things grow. And I think in the case of Pledge, it's like, being regenerative of ourselves, we're not going to go away, but do we need to think about sort of how do we turn the next card and what that looks like? So we're talking about Sean.
Let me know how I can get involved. I would love to dive into Pledge a little bit more.
Well, certainly anyone listening who's interested in Pledge can go to the website pledge1%.org and learn about what we do and take the pledge, things like that. But we're also going to probably start doing some ideating on what's this model look like going forward? What are other constituencies that we can serve? How do we get back more directly to entrepreneurial ecosystems, and particularly around access?
Yeah.
And so if you've got ideas on that, I'd love to hear from you, right? And my email is simple. It's Seth@foundry.vcs.
Beautiful.
I'd encourage you to reach out.
And Seth, before I let you go, for anyone listening who wants to go deeper on dynamic capitalism, where should they find your book again?
That is a good point. My website is thecapitalevolution.com. And there's a bunch more there. Or if you go to sethlevine.com, you'll find links to all this kind of stuff.
Beautiful, beautiful. Seth, thank you again. There's a thread running through everything you've built: Foundry, GoodBread, Pledge 1%, even this new book. And it's that capital is never neutral. It always carries a thesis about who deserves access and who doesn't, whether anyone admits it out loud or not. The work for both of us is making sure that thesis gets wider instead of narrow. Thank you for plunging into prosperity with me today, Seth, and everyone listening. If this episode moves something in you, share it, leave it a review, tag a person in your life who needs to hear this conversation. Come find us at plungeintoprosperity.com or sacralcapital.com. This is so much more waiting for you there. Until the next time, again, thank you, Seth.
Thank you, Brandi. This is so much fun.
Yeah, I am Brandi, and this is Plunge into Prosperity. Have a prosperous day, everyone.
Thanks for plunging into sacred wisdom and regenerative wealth with us. If your soul and your portfolio just got a glow up, hit subscribe on YouTube, Amazon, Spotify, and Apple. Share it with your crew. Tag us on social and join the movement at plungeintoprosperity.com. I'm Brandi Kolosky. Catch you on the next plunge.